All right, thank you very much. So, my people, the last time we met on Friday, we looked at um flexing a budget, flexible budgeting, and we also looked at budgeting in the public sector. So, those who couldn't make it, kindly contact your colleagues who were in and see how they could be of help. And then with regards to um, the budgeting in the public sector, it is more of written. So we went through the written aspect, and I've posted the notes on the page. I just scanned from the manual, so you can equally get it and read through. It's very important because that is the last topic, and it's likely that the examiner will go written. Especially, it's a new topic that has been introduced. It's a new topic. They replaced the capital budgeting or long-term decision making, which has been replaced with budgeting in the public sector and evaluation of investment in the public sector. So it's almost the same thing with uh, long-term decision making. Just that long-term decision making is in the private sector, whereas the current one, they are looking at it from the point of the public sector. So kindly look at it. And then in the process, we made a point that when you come to the budgeting in the public sector, they will use questions will come, and if you have the knowledge in the private sector, you just transfer that knowledge. So we have a question here which is under cash budget, and it is related to the public sector. But once you know how to go about cash budgeting in the private sector, you can easily relate and be able to do it. So let's quickly run through this question. Cash budget. I've posted it on the page so you can look at it. On 31st March 2020 something, 2020X, the bank balance in the books of Department of Trade was 900,000. The department provides you with the following information. So January up to June, IGF, Government of Ghana releases donations, salaries, goods and services, office equipment, and advances. So these are receipt and payment. IGF is receipt. Government releases receipt to the department. Donations, people donate to the department. Then the department now pays salaries, pays for goods and services. They will buy office equipment and also give advances. So once you know the differences, you know those that are receipts and those that are payment, then you are good to go. Then the relevant news to the data. The internally generated funds are made up of 70% cash receipt and 30% receivable. The receivables are collected as follows: 60% in a month following the service delivery and remaining 40% in the second month following the service delivery. The department is entitled to retention of 80% of the IGF collected and the remaining 20% payable into the consolidated fund, the central government fund, in the month in which the money is collected. All right. The department also enjoys budget allocation and government promises to follow schedule. That's 3. The department anticipates some donations as shown in the table above. It is expected that 30%. Okay, so I'm sure you read all this. So let me skip. So before you watch, please read. So if you get here, go and read and come back and continue. All right, so we are supposed to prepare a cash budget for the department for the second quarter 2020X. That is from April to June 2020X, showing the cash forecast for each individual month and the total for the quarter. All right, so let's use Excel. So cash budget, cash budget, cash budget for second quarter of 2020X. So let me bolding that. All right. So we have April, we have May, and then we have June. Then comes the total. The totals. All right. So with this we are good to go. So we start with what? Inflows. Inflows. See that. So please don't forget all this in exam. Very important. So that I can get the maximum points. Okay. So we can deepen or bolden inflows. So we start. Let's look at the question. The question gives us so the inflows will be IGF, Government of Ghana releases and donations. You see that? So let's start with IGF. All right. So IGF. What does it say about IGF? Internally generated funds are made up of 70% cash and 30% receivable. So we can have a schedule done so that it makes it easy. So IGF receipt schedule. IGF receipt schedule. So we have from January to June. See that? And then, so IGF. So let's go and pick the figures. For 100, 900,000, 300, 900,000, 300, 1,200, 1,200, 1,000, and then another 1,000. All right. Okay, so cash. We are told that is what 70%. So 0 point this times 0.7. So all right, so that's cash. Then credit. So when you deduct the cash from the total amount, you get the one that will be credit. You see that? Then we are told that the receivables are collected as follows: 60% in the month following the service, and remaining 40% in the month following the service, in the second month following. All right. So collection will be as follows: first 60%, then the last 40%. So first 40%, 1 month following the IGF, the month it relates to. January, 60% will be received in what? In February. So in that manner. Then you see, so for March, they will receive 60% of February's own in that manner. Then the 40%, January's own will be received in March, 0.4. The same thing for the others, 2 months delay. See. So if you want to know how much we are receiving in April, so it will be these two. See that? So when we come here, IGF, so we can say cash IGF. So then we go and pick the cash. as they appear. And then the total, we just sum everything. Then we receipt in IGF owings. So for that one too, we go and pick the totals. See, these totals. So it's for the two receipts. All right, so then get the total. So that's that for the IGF. So we will receive some cash and some an installment. And that is okay. All right. Then we are told that the department is entitled to retention of 80% of the IGF collected, and the remaining 20% is payable into the consolidated fund. So out of this IGF collected, here, they are going to retain only 80%. 20% will have to go to the consolidated fund. So with this, we can start with our outflows. So it is easier for us. So we can say IGF transfer to consolidated fund. You see that? So out of this collected, this plus that, you see, this plus that, 20% will be taken to the consolidated fund. So we are treating it as outflow because it will leave our accounts and go to the consolidated fund. See that? All right. So we are done with IGF in its entirety. And we are told that in the month in which the money is collected, so the month in which it's collected, if they have said it will be paid in arrears, would have done that. So it's the same. The department also enjoys budget allocation and government promises to follow on schedule. All right, so the government releases will come as scheduled. So April, they will receive the 600,000, 600,000, May and June. So budget releases. So 600 for the 3 months. All right. Then the department anticipates some donations as shown in the table above. It is expected that 30%, 40%, and 70% of donations in March, April, and June respectively will be in cash. The remaining are expected to come in the form of material. Remember, this is a cash budget, so we are only interested in cash received and cash paid. So the materials we will not consider because they are not cash. So let's go and see the donations. So the donations, we have March, April, and June. And we are told that for March own, we will get 30% in cash. April's own, we will get 40% and 70% for June. So donations. So April's own, that will be 40%. And the amount there is 200. All right. So April equal to 0.4 times 200. Simple. You get that? And then the June one too is 200, but that one we will receive 70%. All right, so June equal to 0.7 times 200. Here will be nil. All right, so that's that. Let's move on. The next one is staff salaries will be paid at the end of each month. So we pick them as they are salaries, 620, 550, 660. So those are what? Payment or outflows. So salaries. So we have 620, 550, 660. 620, 550, 620, 550, 660. 660. All right. So as simple as that. Let's move on. The next one, goods and services are paid for 1 month in arrears, meaning we will delay for 1 month, then we pay. So March own will be paid in April. So March is 400. It will be paid in April. So that will be goods and services. So March own is 400. It will be paid in April, 400. And then 320 April we paid in May, 320. And then May's own 220 will be paid in June, 220. Correct one. That's that. So after that, the next is what? Office equipment acquired in January will be paid for in the 3rd month following the purchase. So January 3rd month will be February, March, April. So the January own will be paid in April. So let's go and so it's 600. It will be paid in April. Office equipment. Office equipment. So 600. And then the June's own, let's see what they say about that. And one to be acquired in June will be paid for immediately. Oh, okay, so the June's own will be paid immediately. That's 500. So it will be paid in June. So June, 500. You see that? All right. Let me freeze here so that we have the all right, so we can still see the months. All right, so that's fine. Let's move on. So after that, we have office equipment is depreciated. Depreciation doesn't come here. You see that? All right. Then the next one is the advances. In 2010, staff of the department will be granted advances under an advance scheme approved by the government. The advances will be recovered in 4 equal monthly installments, beginning in the month following the month in which the advances are granted. Okay. Advances in January will be repaid in 4 equal monthly installments, beginning in February. All right, okay. So the advances, they will first go out as what? Outflows. And then when they are paying back, that one, it will come in as what? Inflows. So advances, so outflows, advances. So April 40, 60, 50. So 40, 60, 50. See that? Then so how the repayment of so receipt of advances repayment. Okay. So that one, unless we do some calculation. So January to, so let's bring that here. So calculation of advance repayments. All right. So let's also do January up to June here. Okay. Then let's see the advances they paid. 50, 40, 50, 50, 40, 50, 40. All right. So 50, 50, 40. Now let's go this way. 50, 40. Okay, so we need to pull this here. 50, 40. We are only copying 60, 50. Whatever we have, the advances we have. So these are the advances. January 50, February 40, in that manner. And they are saying that, see what they said though. They are saying that the one we took in January if we are paying, or if they are paying back, they will pay it in 4 equal installments, but it will be a month after when they took it. So the January one, they will start paying in February in 4 equal installments. So divide by 4. You see, so the same amount in that manner up to May. So 4 months, 4 equal installment, 50. You see that? Then the February one, they will start paying in March. The same way, 4 different installments. So divide by 4. You see that? So that one too, up to June, they will finish paying. Then the March, they will start paying in April. So divide by 4. You see that? The same thing. Then the April one, they will start paying in May. So this divide by 4. You see that? Then the May one, they will start paying in June. Divide by 4. The June, they won't even pay. So this is how they will make the payment. So April, let's see how much they would have paid. In total, they would have paid 35. May, they will pay 45. And June, 47.5. So the employees will pay. So that will be an inflow for the department. So 35. Okay, let me even go and pick it straight out away. All right, so that's that. So let's pull this back a bit. See that? So now let's see the total inflows and then the total outflows. And then the total outflows. See that? So we start with what? Balance brought forward. That's the opening balance. Then we add surplus or less what? Deficit. Then balance carried down. All right. So balance brought forward. We've been told that as at 31st March, they had 900. So that'll be the opening balance in April. So 900. Then inflow, total inflow minus total outflow. Wow, that's only one. Okay, so balance carried down will be 9. Why? All right. So then this balance carried down will become balance brought forward in May. Then we also have our inflow outflow. So that will be a surplus. So when we add, we get the closing balance. And then the closing balance will also become the opening balance here. We add and we are there. So the opening balance will be this. And then the total surplus will be this. And then when you add, you get this. See that? So that is that for this topic. I will entreat all of you to look at it before you go. I'll send this Excel work to you and also upload this video on YouTube and share the link with you so that you can quickly run through and familiarize yourself with it before you go. Thank you very much. See you. Bye-bye.